I think I'm going to live tweet this panel. I just had a horrific realization.
Uh-oh.
I'm trying desperately to catch up to Beezer in number of Twitter followers. I'm like obsessed with this, and it's never going to happen. And then I just realized, like, when you were announcing us, Beezer was not Beezer Clarkson. She was just Beezer. She's like the Cher or the Maradona of the industry. I'm toast.
That's because you haven't heard me sing.
Awesome. So we're, again, excited to have you all on the panel. Thank you for joining us. Would love if you could just quickly give your introduction. And also, how did you end up becoming an LP? I think that's something that folks are curious about. So maybe the quick story on that.
I don't have any quick stories. I know that. When Twitter started, Rob Hayes goes, like, he said, Douvos, I don't know how you're ever going to be on Twitter because you can't even say hello in 140 characters. But I'll try. I'll try really hard. So Venture Investment Associates is almost 25 years old. We started, our founder is the Hubble Space Telescope of Venture. He sees all the way back to the beginnings of the universe. Allegedly, the firm Sigma was named after him. He was the director of investments at American Express for many, many years. And then when they were going through corporate tumult, spun that out into the first fund of funds. It was backed by Yale and Stanford and a bunch of folks in '93. His son joined the business in 2000. We started an energy practice, and I joined in 2011. Today, we manage about $2 billion in a mostly fund-to-funds format, although I run a fund that's focused on micro VC and emerging managers, in which we do a bunch of co-investing, and that is hella fun, as the kids say. And so that's our fund. How did I get into LP investing? I spent my summer when I was in business school at Morgan Stanley and hated being employee 64330. And I went back to business school and I called up my buddy Seth Alexander, who was a year behind me in college and was then in the Yale Investments office. And I said, Seth, I had the worst summer ever. I want to do something that I want to be a principal, not an agent. And he said, you should find out about endowment investing. He said, it's amazing. It's like we're the perfect investor. We've got a low liquidity needs, a long time horizon, few tax headaches. It's absolutely, an amazing gig. And I said, well, are you guys looking to hire anybody? I'd love to come join, work for Alma Mater in the Yale Investments office. He says, no, sorry, but you can go talk to Princeton. So yeah, I ended up working at Princeton, where, as they said in Roman times, ubi panis, ibi patria, where there's bread, there's my country. So there I was with two, Yale degrees, a spy behind enemy lines.
Nice, thank you.
I hate following you.
Better you than me.
I've got no Latin, although I studied it in 6th grade. All right, so Sapphire Adventures. We are a international leading venture firm, and we invest, as like what Chris was saying, we do both sides of the house. We have an evergreen vehicle out of which we make LP investments in early stage funds, primarily funds focused on Series A, US, Europe, and Israel, and that's what I do, that's what I manage. And then we also have a very large, with a direct growth stage investing vehicle, and that's got a 20-year plus history, so that kind of goes back a good long way, and that's the firm. How did I get into being an LP? Well, I started out my career at Morgan Stanley in the 90s, but also was not destined to be an investment banker, so they say. I started in venture on the direct side in 2000, back when VC/incubator first happened in New York, which went away quickly in 2001. And between then and now, I think we covered... I'd say I moved back and forth between direct investing and then also being an operator. I spent a number of years doing software business development, and I offer that only because when I tried to get onto the LP side, I was told by somebody, oh, that's going to be really hard. You needed to have worked in endowment, come out of this whole path, and that just wasn't true for me. And I actually think the direct investing side and the operating side's been super helpful. But I started doing the investing, both sides, the direct and indirect, about a decade ago, and have been building on that ever since.
Great. Hello, everyone. I'm Lisa Edgar. I'm with Top Tier Capital Partners. We're a venture capital fund of funds located here in San Francisco. We have a little bit over $5 billion of assets under management, all in venture. And then we also advise one large institution on their broad private equity as well. We do investments in funds from 40 million, 30 million in size, all the way up to $1 billion. And then we also do co-investments in secondaries. Secondaries are kind of in our DNA from where we came from. Top Tier actually is a spin out of something called Paul Capital. So secondaries have been part of our program forever. I became an LP in the venture fund of funds business when there were only 5 fund of funds in the whole entire world. So I'm one of the old timers in the business. It's been fun to watch. Nobody really came out of a fund of funds or any place else, and so there were a lot of kind of bankers and investment professionals generally that were my colleagues at the time. And I actually was at the Federal Reserve Bank of San Francisco in the Economic Research Department working on the Beige Book when I got in there. So there you go, no straight path.
Love it. Thank you. So there are a lot of managers in the room here, and I know many of them want to know, what do you guys like to see, and what are some of your pet peeves as you chat with managers as they come to you to raise capital? And we will also get to the secondary thing, so I'm excited to get your thoughts on that later. But first and foremost, managers.
Or pet peeves.
Start with pet peeves if you like.
I mean, I think at this point it's a very noisy market. Nobody in this room is surprised to hear that. And how do you stand out against the crowd? And I think this is continuously one of the hardest things. I think I now spend a lot of my time encouraging people maybe not to raise a fund. Although I think there are certain strategies and certain people that have very specific and unique networks and deal flow and a place in the market that they do come in every once in a while and you go, wow, this is different. And then you try to get to know them and spend the time, but I think it's hard. And pet peeves are obviously people that try to speed up the get-to-know-me process, because it's impossible to speed up the get-to-know-me process no matter how you try. And I don't think some people understand that.
I think one of the things I say repeatedly, so my apologies for anyone who's been subjected to this, is sort of why your firm, why what you're investing in, why the LP base that you want. And this gets at how do you stand out, because it has to come, in my experience, from an authentic place. Otherwise, the entrepreneurs don't resonate with it, and that's obviously a super critical part of it. And it's not just for people standing up new funds. This is a continuous situation because it is super competitive at all stages. And if you don't know who you are and why you're there, someone else will figure it out, because the end product is money, and money's pretty fungible. So it's sort of a consistent question that we always ask.
I key on a couple of things, and Beezer used one of my favorite words, authenticity. And it's totally amazing how inauthentic a lot of people are when they come to. In fact, half the meet. I have an open door policy. I think I met with 270 managers this year, and after number 18, it was all like wah 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 wah. We're in SHIP. We're in this. We're in that. I'm like, everybody's in the same 9 deals. It's amazing to me I want to see the cap tables of some of these companies. Sweet Jesus. Anyhow, so the things I focus on are people who have an unfair competitive advantage. There are a lot of people out there who have competitive advantages, but I'm focused on the truly unfair. And
so in this market, what's an unfair competitive advantage? What's an example?
So I will give an example after I think of one. No, just kidding. So one of my keywords is because I'm simple-minded, I think of things in keywords. So I always talk about leveraging ecosystems. So here's an example that's actually not yet formed, but I'm trying to encourage them to form something. But does anybody here know Cyclotron Road up at Lawrence Berkeley Lab? Right? So Ilan and those guys and Matt and all those guys are doing some really interesting stuff. And that's they potentially have access to an incredible resource there. That's an unfair advantage. So I'm trying to get them to either raise a fund or do an opco that I can invest in, because that's an amazing ecosystem to leverage. Or another recent investment, I just backed Jeremy at the House Fund at Berkeley. Right, and I think that if I could do a pairs trade, if there was a market for universities, I would short Stanford and go long Berkeley, because that's a moneymaker all day long.
Go Bears!
Yeah, exactly.
Go Bears!
My laptop, I've got a mascot. I've got a sticker on my laptop. It's the mascot of the Berkeley Hackers Club. And for those of you who don't know Berkeley, their mascot is named Oski the bear, and so the mascot of the club is called DDoSki. Right? I have to explain to some people what a DDoS attack is. Anyhow, so enough. We could go on for days, and sometimes I do. But no, kidding aside. So authenticity, unfair advantage, and then the other one is repeatability. It's amazing how many people out there are using lottery slogans with the Ivy League veneer. Optionality is the same as you got to be in it to win it, right? So we're not playing a game of a dollar and a dream.
Right. So you talked about repeatability. One of the things that emerging managers don't have, unfortunately, is repeatability. So maybe we could spend a little bit of time chatting about emerging managers. Do you have emerging manager programs? How do you look at those folks differently than maybe other more, second, third, fifth-time fund managers?
Yeah, we have a program. We don't call them emerging managers. We call them alpha managers. It's just a much better, and we do expect them. They're generally small funds, and we expect them to really be able to outperform in a lot of ways because they're doing something new and unusual, and they have a small denominator to do that. So with a small exit, they should be able to really make the returns that we're looking for. But we do have an alpha manager program. We've been active really from the beginning of time, but given this new kind of the micro VC, the pre-seed and seed activity that's happened, we've really kind of formalized it and created a pool of capital specifically designated for these managers. I don't think any of us are really backing first-time investors, and so there is not a fund, 1, 2, 3, and now you're doing 4 that you can go look at, but you can certainly look at what I call, what is your body of work, whatever that might be. We've seen in the past, you have an investor come with an operator, and we've been able to analyze an operator's body of work. What companies were you involved in? How did you really game change that company to make it something bigger than it would naturally be? But we're looking at now, most people have angel lists or angel deals that they've done. You can look at that. But we would never back a first-time investor, but we've backed many first-time funds.
I think it's a really important nuance that Lisa's pointing out is that I think from the outside, it looks like these funds just pop up overnight, and it's like you just plucked money out of the air and it happened. And I don't know, I don't think that ever really happens. At least it hasn't happened when we bumped into it. And there's usually really interesting backstories, right, for the body of work that isn't known, and it's not a 2-day fundraise, and all these things are going on behind the scenes, and it's just not transparent for important, sort of fundraising businesses. You can't publish that you're fundraising. There's laws against that publicly. But I just think there's a lot more backstory and how hard it is that people don't get a chance to see.
It's funny because I've done a lot of crazy things in my investing, and it comes from this belief that that so many people are afraid of being wrong and alone that it prevents them from being right and alone. And being right and alone is where fortune and glory reside. And so I've always tried to be the fool that rushes in where angels fear to tread. And and I sit here and it's really funny because I was about to tell the story, the foundational story of First Round, where I was the first backer, first institutional investor, and sat with Josh and kind of built the idea of First Round in kind of 2005, 2006, or being the first investor at Lemnos, or the first investor first institutional investor at Data Collective in Fund 2 alongside Beezer. And there are all these things that I've done that where I could tell all these stories, but there are all these things that are contemporaneous to all those things that completely screwed up. And there's this great kind of bias, right? Because you only have to be right once to have kind of build a name. I call this the Blodgett Effect, because all you have to do is call Amazon at 1,000, even though you may not, you're wrong 800 times. If you're right that one time, it'll make your name. And I think, quite frankly, a lot of people are doing that today. And actually, that's one thing that's scary. A lot of people are. I talked to an LP the other day who's new to the LP business, and they're like, "I just want my first round," and I'm like, well, back then there were a dozen firms that were doing micro VC. Today there are 450. It's a different marketplace. You don't want to find the next first round. You want to find the first, whatever it may be.
Great. And actually, so speaking about the seed stage and pre-seed stage, we think we've seen a couple of articles recently that said there's been a dearth in kind of pre-seed and seed stage funding in the last year or so. And we'd just love to hear your thoughts on kind of that stage as a whole. Do you invest there? Is that of interest? And maybe what do you make of the fact that some of that capital is disappearing out of that angel and pre-seed stage?
My favorite phrase of the fall, by the way, is mango seed. This is like the new thing. I love this. Like mango. So we got pre-seed, seed, mango seed.
I know who that is.
Who is that? I want to know who came up with that, because I want to throw a nickel in a jar every time anyhow, neither here nor there. Where I'm going with this is actually I'm doing my own firm's annual meeting in a couple of days, and so I was like scribbling my slides, kind of sitting over there, last year I got Walt Whitman in. This year I've got The Little Prince and Gatsby, so I'm really excited. I like to mix it up a little bit. But anyhow, I was looking actually at the data.
Lisa and I took bets on how many quotes you were going to do from Walt Whitman.
Yeah, and I brought a couple just in case.
Walt Whitman talks about I see the genius of the modern, the child of the real and the ideal, right? California, populous cities and the latest inventions. Stirs the heart. Anyhow, where I'm going with this is, like, if you actually look at seed funding, it actually explodes through 14 and 15. I mean, it's crazy. And as I was sitting there looking at the data, I'm like, oh my God, what happened is a lot of employees became founders and a lot of founders became VCs. Get out. Get out. It's like a horror movie. Like something bad's going to happen in the house. Get out, right? So everybody's now talking about like how, but it's a total recency effect, right? Like it's, the data is still like at 2013 levels, right, in terms of activity, and I think that's fine. I think that we need more people out of the business so that there can be more beer for us.
Well, one of the things that I quickly pulled some numbers. Thank you, PitchBook. Looking at how many new funds are launched every year that are sub 100 million, because just making a gross guesstimate, those are the ones who are probably most active at pre-seed, mango seed, whatever seed. And it's really, I was shocked to see this. I hadn't looked at it before. It is pretty consistent. Around 100 new sub $100 million funds are formed every year. And I was like, oh, that's really interesting. I mean, I don't know how that contends into this stuff, but I was like, it's the funds coming in that could be doing it are still there, and the ones from the past might be. So people are making a choice, I guess, was my sort of base takeaway, that the market seems to have a stable appetite for this fund creation, and companies will fluctuate up and down because there are other monies coming in outside of that. But there is a stable state, and we'll probably just revert back to it.
But there is a little subtlety here. There were seed funds. We all got that. That kind of made sense, actually. Then there was pre-seed, and we're like, oh, crap. Do we need to do the pre-seed too? And who's doing the pre-seed? And is that a pre-seed because they couldn't get a seed? Or do they go from pre-seed to A? Or do they go pre-seed seed A? And what happens? And who's doing it? And who, I was like, oh, my gosh, what's going on? And it's been interesting to talk to people, like when you are talking to someone where if they're seed, they poo-poo the pre-seed, right? Because it's like, oh, no, I'm doing that too, and I'm first. And those are the people, and they're not giving them enough capital to get to the milestone, the next place that they need to do to get funded. And then, the pre-seed said, oh, no, we do, and we get them all teed up and go to the best seed. So, it's just been interesting how this whole funding activity has been cut into smaller and smaller segments. So I think that I'm still trying to figure out that pre-seed thing, but I will tell you, I know a few very credible individuals that have funds that I think are good investors, but that's one place we haven't quite gone yet, I have to admit.
Well, one of the things that you and I talked about before was if everyone is running out of the room, right? I think Fred Wilson's blog/tweet the other day suggested maybe it's a good time to come in. And one of the things we were talking about was, well, then how do you wrap that up into an investable fund? Because there's a difference between the two, right?
Absolutely. Yeah. So that we'll switch gears a little bit, and we'll talk about how do you think about managers and their strategies for reserves, and kind of how should they think about keeping capital for follow-on investments, and maybe along those lines, do you do any co-investing, and if you do, kind of how do you think about that in the context of saving some capital?
Wow, it's a whole lot going on.
You. A lot of questions.
Usually, I'm going to make a gross generalization, then my wise colleagues will break it down into useful things. That's the challenge of the pre-seed seed fund, is how do you raise a fund that can stay at that level and be meaningful and have reserves? And that's why Series A plus funds have a portfolio construction that's usually a bit more logical, and historically there's numbers to put towards it, right? And when the market's up and to the right and there's lots of capital, reserves are more about continuing to invest into the companies you want to be with. We haven't had a significant downturn in a while, but when there is one, that's sort of the concern around where are the reserves and how do I help my companies. And that's the stress test that we just haven't seen recently, but historically was where reserves played a really important part. Pause on that. We do co-investments with our GPs. We do it fairly judiciously. We tend to do it. So there's a pool of capital that we have in an evergreen vehicle that does our LP investing. Separately, there is a significant growth stage vehicle. When the direct growth stage vehicle invests in one of our underlying funds, I will co-invest with them with another check. That's because there's a whole team of really smart growth investors who are leading the charge. I don't need to split my brain and do 18 things. I handle one direct thing at a time.
Yeah, I mean, we do co-investing too, and we really think about the word co in that, so we're not direct investors. We really find who we think are some of our best partners, where we have good relationships, good authentic relationships, and we can co-invest alongside them. So that's what we do. As far as reserves, you know, the first wave of folks that came in with these small funds didn't understand reserves at all. They didn't have any reserves, and then they had to raise the opportunity or growth funds or whatever. I think now people have gone to a number of conferences, some of which we've helped put on to really kind of teach people what it is, what does reserves mean, how should you do it, how should you do it at the early stage, how much, what to do. But, you know, Beezer's point is really important, that it's been up and to the right. There has been people to fund these things. The folks that come in and say, oh, my company's got funded, you know, is actually not a good thing. I tell them that's not a happy thing, because all your companies probably should not have gotten funded. So, but I think people are a little bit better on reserves. But what is the exact level of reserves? I think it really depends on the strategy, how early you're getting in, you know, what other funds you're thinking about raising. It's kind of unique, but you do have to have reserves to support the winners and let the ones that aren't kind of working go. And like we always say, back up the truck to the winners. You get the ownership percent. It's the only way to get a return.
I used to say this, and people, especially in San Francisco, I'd say this, and people would like really give me the side eye. Like down in Silicon Valley, I'd get a little bit more of a moderate response, but it seemed like a controversial thing to say. And then Fred Wilson just wrote a blog about 3 months ago saying this, and I feel compelled. I can say it loud and proud. I think operating experience is way overrated in terms of fund management, and I think venture capitalists are at their heart investors, and we undervalue investing skills. And Fred wrote a great post, you know, that talked about the greatest venture capitalists of all times, and you know, Mike Moritz and Jim Breyer, and you know, blah blah blah. You go down the list, and very few of those guys were quote unquote operators. And I think that's the the greatest like challenge I think that that we're going to face looking back on this period, is that all these people who should have been founders became VCs. Why do I riff on that in a seemingly like unrelated point? It's because I think that one of the things as I look at you know, when I look at portfolios and I talk to portfolio managers, which is what a VC ultimately is the portfolio construction is complete heaping crap, and it's amazing how people, you know, don't think about their portfolio construction. They don't think about reserves, you know, typically in the right way. They don't think about valuation. They don't think about the dynamics of portfolios in terms of one exercise. I wrote a blog post a long time ago called RTFE. Return the fund equivalent. It's actually RTFF, return the fucking fund. And basically it was this analysis that...
you said you weren't going to swear.
I'm sorry. I hope my mom's not watching.
Panel bingo.
My son, you said the bad word. So basically the analysis is you look at all your portfolio companies, you look at the ownership you have, and you try to understand what kind of exit does each individual company need to have to return the fund in it by itself. And then it's actually a Rorschach, right? Because it gives you a sense. There's no answer per se, but you start to understand like, oh my gosh, my median company needs to have a $32 trillion exit for my 8 basis point ownership to like make sense, because I and everybody else I'm in, you know, that company, right? Anyhow, whatever. I'm over it. So what I'm saying is like there is a lot to learn about portfolio construction and reserving, and there's some great old masters of this stuff that are talking, but not a lot of people are listening.
jump over to secondaries, and also shout out to the Raise conference that I know you mentioned earlier. But let's talk a bit about secondaries and kind of that shift that we've started to see now, I think, in the last few years with folks being more active in that space. Would love to hear your thoughts on that, and if anyone else has anything to add to that.
Yeah, well, I mean, we do secondaries on both the LP side, so we'll buy a fund interest when we can in the secondary market, and those are usually done at a discount, and we do venture only. So a lot of people don't understand how to price venture assets, so the big players in the secondary market are generally don't want to touch it. So it's a smaller world, it's a more niche-y world. We have a lot of data because we've been in the business for a long time, so we think we have an advantage with that. So we do that all day long. And then we'll also do secondaries in companies because we have a co-investment activity. Sometimes there are, this is a whole controversial thing, but it's now part of the program where there's founder liquidity that happens. That used to be a big no-no back in the day. Now I think
Not that long ago.
Yeah.
5 years?
Yeah.
Not that long.
Yeah, 5 years it was still a big no-no. Now it's kind of par for the course. People are getting some founder liquidity. We get it. It's expensive here. A lot of people are using it to get a house or to pay for the kids' school and stuff. I think most of the good investors are trying to limit it so that nobody, checks out with the founder liquidity, but we'll do secondaries in companies too. And I will tell you, all the big name VCs do it too because they're backing up the truck, as I said before. So we try not to compete with them, and we do the dance, but all the VCs will buy secondary positions in their best companies as well.
Please.
The other, the neuron for me also that fires with respect to secondaries is, kind of fund-to-fund transactions. And I had always hoped that, as I was sitting there with some of these cats in 2005, 2006, talking about like the promise of what would become micro VC. I thought this was another arrow in their quiver, because at the end of the day, you got to put the moolah in the kula, right? It does not do me a lot of good that FRC2 is sitting on, $3 billion or whatever the number may be of Uber shares, right? As they got to ring that register, and we've seen too many companies, Fab and Blue Apron, and other, kind of go up and come back down. And my response is, was it Trading Places or Coming to America? Was it sell, Mortimer, sell? You got to
Trading Places.
Thank you, thank you. I'm telling any of my, there used to be a lot of worry about signaling. But I think there's just such a, and speaking of Uber, obviously SoftBank is poised to buy a lot, and I would recommend to any VC who has a chance to sell, and any employee too, to take some off the table.
Yeah, let's talk more about liquidity because it's such an important topic. And I just saw somebody here earlier today that talked about taking some money off the table. He took, I think he said 3x return from his investment off the table, and still is holding, a big chunk. We had a really old school VC came into us yesterday and said they're selling a 25% strip of 2 of their older funds. So they're asking all the LPs to participate. And if you don't, that's kind of okay. Others can do more, but they're doing this. I am getting more and more excited about people being creative about how to get liquid on some of this, because there is a lot of cash in the system, but not necessarily a lot of liquidity back. We actually sold a big secondary in some of our, so we sold some funds in the secondary market in some of our older funds, because our LPs as well, I said earlier, we're a fund of funds, they are asking us for liquidity. So we did it as well. And so these markets, there are different structures and different transactions, and I do think you have to be more creative, especially when you have these very highly valued, assets that you're holding. We're not saying sell it all, but for goodness sake, give it, let's all get some cash back.
Moolah and the Kula. All right, so it wouldn't be a 2017 panel without us talking about crypto, so we're going to do it. All right, so how are you guys thinking about funds and kind of getting allowances for tokens, accepting tokens, and then, of course, are any of your funds, or are you investing in any funds, crypto hedge funds, or kind of more direct or active sort of ICO-focused funds?
Yeah, I heard that Chris is actually raising a crypto fund, so maybe let him.
Actually, a crypto hedge fund.
Oh, that's right. I forgot.
Kidding aside, like I don't know if you're joking about one of my tweets the other day, which is I think I'm the only person who's actually lost money on Bitcoin.
Really?
I've actually lost money on Bitcoin. I'm really, really upset about it, and I feel really stupid. But I bought I was like, I should get in on this, and I bought. Actually, kidding aside, somebody once I won a bet on a golf course, and somebody gave me a Bitcoin like 3 years ago, and it was $10 or something like that, and I still have that. I don't know how to access it though. I have no idea where it is. It's somewhere. But then I opened a Coinbase account like 6 weeks ago, and I bought it like 8,000 and rode up to 11,000, and then there's that day when Coinbase was all funky and went back down to 8, and I'm like, I don't understand. I don't understand why this moves. And then I'm like, wait a second. I'm not an investor, but I play one on TV. And as an investor, you should understand value equals opportunity equals value minus perception. What's happening here? I started applying all my investing rules to this, and I'm like, I don't know what the fuck I'm doing. And then I was like, I'm gonna sell everything. I ended up taking a $10 loss. I'm like, stupid Bitcoin. And yeah, so long story short, what I had, the one thing I can say that's at all interesting to me at least, is I was with one of my managers the other day, and one of their portfolio companies wants to do an ICO. And they said that their lawyers, Gunderson, are now telling them to put provisions in all their company docs to prevent companies from doing ICOs because, for any number of reasons that are all very sound. So I think we're going to, there's some promise, maybe this is a new liquidity avenue, but I also think that it's one to be approached very cautiously, and it's one that I'm very scared of.
I'm more bullish on it, actually, just to be honest. But I'm bullish kind of on the blockchain. I'm bullish on some of the different currencies and such. But we have had legal documents, so LPAs, the limited partnership agreements, come through with language. We have actually had amendments to certain funds because they are considering the ICO and the cryptocurrency as a security, so they increase the amount of publics they can do. It's going to end poorly for a lot of people, but there's a lot of smart people that I know that are actually investing around it and doing some interesting things. There's been a couple companies that I've met the founders. I think they're building real companies around the infrastructure of blockchain and cryptocurrencies, and then they went out and did an ICO. If I had more time, I would have actually tried to participate in the last one because it's a complicated process. And I have a friend that was trying to tell me, and I'm like, oh my gosh. So I thought I should do it, just to understand it. I didn't. I was moving. I didn't have time. But I'm kind of bullish on it. But there's going to be ups and downs, and all kinds of people are going to lose money. But I think long term, it's the real deal for security, for logistics, for a lot of stuff. So.
One of the things I'm just going to, I think you guys are both making valid points, so I'm not going to repeat them. But one of the things that I find incredibly notable about the venture industry today is the velocity of adoption is just so darn fast. So that when one person starts doing something, it was scout funds, it's crypto funds, it's value-add services. It takes, 10 minutes for it to ripple through the industry, because we too now have every single fund that comes to me, barring something where it's just completely inappropriate, has a carve-out for cryptos. That was not true 6 months ago, right? So you just watch this velocity of adoption and adaptation, and nobody knows yet how these things play out, because it still takes the average company 8 years to exit. It takes the average venture fund 12 years, 14 years to wrap up. So there's just this really disconnectedness, right, between people taking new ideas and implementing them and then seeing how it happens. So we're in for the ride. We'll see what happens.
Right. And if I read correctly online, you guys are investors in Union Square, and they've been pretty active in the space as well.
Oh, yeah, we have portfolio exposure.
Great. Well, let's see if there's any quick questions on the Slido. If there's anything up there, perfect. Okay. I read that one fast. So. That was you.
That's what I was texting.
I want to answer that. No.
Let's take the third one.
I never thought of raising a fund.
So how will you handle?
Well, I love the first one because
please,
it's actually interesting. And the question is, aren't fund of funds MDs just repressed GPs who couldn't raise their own fund? I think that was the question. And the short answer is, I think that's really funny. The short answer is, No. The answer is they're actually completely different businesses, right? As a GP, you're trying to understand technology, its potentials, unit economics. I'm trying to understand people. I consider it a win when somebody walks out of my office and says, this happened last week. Somebody said, oh my God, I need to send you $200 because this is like therapy. I actually ask somebody, I often ask, like, what's your biggest personal disappointment? And how did you work through it? If you haven't read my blog post, The Worst Meeting I've Ever Had, that's the name of the blog post, take a read through it. I love it when people haven't read it and they come in and meet with me, because then I ask them the question and it totally flummoxes a lot of people. And so I almost consider it like, which by the way, like if you come in and meet with an LP, like Beezer has a huge public presence, Lisa and Top Tier have a huge public presence. If you know nothing about me when you walk in the door, you're a fool. Imagine if an entrepreneur knew nothing about you and they came in to pitch you. So long story short, like I play, I'm an investigative journalist who happens to have a wallet and a checkbook. It's a very different job.
Great. Very quickly, if anyone would like to take the how will you handle the next recession question, just any quick thoughts on that. And kind of we've had a bull market for quite a while here. Curious about your thoughts there.
Yeah, I mean, it's coming. It is coming. I've been through 2 of them. You just have to be diversified. You have to not get caught up in all the hype, and prepare yourself and sell when you can, which is why we just did a big secondary sale, because it's coming. Winter is coming.
Do you know when?
There was a VC once, Barry Cash, Interwest Partners. Now I'm showing my age. He had like a ball in his office. I'm like, it looks like a crystal ball. I'm just going to rub it. Is that okay?
Maybe the answer will materialize.
There you go.
All right, and with that, we shall wrap it up. So thank you so much for fun and insightful panel.
Thank you very much.
Thank you.
Awesome. Good fun, guys.